Okay, so what we need to cover right now is the intersection of elasticity and excise taxes. I'm not sure that we're going to have any time to talk about this stuff in class, so I really need everyone to be up on this. It's, you know, kind of not the most core concept for the AP contest, but I would kind of be surprised if nothing like this shows up. So this is stuff that you do need to know. So the question here is who ends up paying for the excise tax, or like the cartoon would suggest, who gets screwed? Ha ha ha. Let's start by just looking at a few graphs. So we're going to look at a couple of graphical examples. Let's suppose this is the market for cigarettes. As you can probably imagine, the demand for cigarettes is going to be relatively inelastic, right? Cigarette companies put special chemicals in their cigarettes to make demand less elastic so they can get people addicted so people will pay whatever price and keep smoking. Right, so we represent that as you've already learned in our elasticity talks with a steeper demand curve. So you see how this demand curve is steeper here, and really the key for the question on that first slide is which one is steeper, the supply curve or the demand curve. So we'll start with this, what we can call a unitary supply curve with a positive slope of 1, and here we have a more steep demand curve with a slope of -4. Anyhow, so if we put a $2 tax on producers, that means we shift supply up by, oh, here's the consumer surplus before the tax, sorry, got ahead of myself. Shift supply vertically by $2. You can see that the new quantity exchanged after the tax is going to be 9 units of cigarettes, and in our previous examples, we had pretty much always used the same slope on the demand and supply curve, and we had ended up with the same impact from the tax on the consumer price and the producer price. Such is not the case here. So you can see that the market price was originally $5, but now the consumers, the price they pay goes from $5 all the way up to $6.50. And for the producers, the price they pay goes only, or the price they receive, goes down from $5 to $4.50. So per unit, the consumers are paying $1.50 of the tax, and the producers are only paying 50 cents of the tax. And that's because of the relatively inelastic demand curve. So when demand is inelastic, the consumers will pay more of the tax, or when demand is less elastic than supply, then consumers pay more of the tax. So you can think about this like this: flexibility is good, being inflexible, that's bad. And in terms of elasticity, right, less flexible means less elastic, right? The steeper demand curve here is less elastic than the less steep supply curve. And so consumers end up paying 75% of the tax rather than the tax being split 50-50. That gold box shows the total area of tax revenue. 9 units are purchased, and there is the $2 spread between $4.50 and $6.50, and that's the total area of tax revenue. The red is the area of the tax revenue that came out of consumer surplus. And the green is the area of the tax revenue that came out of producer surplus. So you can see that's 75% of the tax revenue came out of consumer surplus, but only 25% came out of producer surplus. And also, there is a relatively smallish area of deadweight loss. So in this case, quantity didn't fall very much, so deadweight loss is not very large. Remember, deadweight loss is created when there is fewer transactions, right? So in this case, there's not that many fewer transactions, so the deadweight loss, or the total inefficiency due to this tax, is relatively small compared to the next example. And in the next example, we see the opposite. We'll take the same supply curve and a demand curve that is very elastic. So suppose this might be an excise tax on a luxury good like yachts. When we shift that supply curve up by $2, we can see that now quantity has fallen a lot. Quantity has fallen from 10 all the way down to 7. So the new quantity exchanged is 7, and the new price consumers pay is $5.50, and the new price that producers receive is about $3.50. So that $1.50 now comes out of the producer surplus. And you can also see the red area, again, is the area that came out of the consumer surplus. Green area is the area that came out of producer surplus. The tax revenue as a whole is less here because it's the $2 tax, but there's only 7 units exchanged, so only 7 transactions for the government to tax as opposed to 9 in our previous example. And since there's less transactions, we see a larger area of deadweight loss. So a couple of things to think about. There's less deadweight loss and more tax revenue when the government taxes markets where demand and or supply are relatively inelastic, and there is more deadweight loss and less tax revenue when it's a tax on a market with relatively elastic demand and or supply, as we see in the different examples between yachts and cigarettes. Here is a practice question for you. I'll go through the answers in just a minute. You can pause the video if you'd like to work through those items 1 through 6. Okay, so number 1, total tax per unit. That's asking you for the vertical shift of the supply curve. Hopefully you all figured that, and since there's this like cross-hatching, the little graph paper kind of behind the graph, it should be easy enough to see at any point. But we can see from the equilibrium price at 5, a vertical line up to the new supply curve is at 8, so the tax per unit is $3. So $3 per unit. The total tax revenue after the tax, 20 units are going to be exchanged in the market as opposed to 30 before. So $3 per unit times 20 units. The total tax revenue is going to be $60. The consumer surplus after the tax is up there. The red box plus the gold box is the total spending for number 5. I think I got ahead of myself here. Tax paid by consumers, sorry. The tax paid by consumers, so you can see that the demand is less elastic than supply. So the tax of the $3 per unit, $2 per unit is paid by consumers. So you can see this kind of top half of the gold box from 5 to 7 and out to 20. This is the amount of the tax revenue paid by consumers. Now sometimes, like on number 3, it might say total tax paid by consumers, in which case you would need to say, oh, $2 comes out of consumer surplus times 20, so that's $40 of the tax, and then $20 of the tax comes out of producer surplus. For number 3 and number 4, in this case, it doesn't ask for total tax paid by consumers or producers. So you could say per unit or total, and you'd be right for 3 and 4. So if you said $2 for number 3, or if you said $40 for the total tax, you'd be correct. And if you said $1 for number 4, or you said $20 as for the total tax paid by producers, you'd be correct. Total spending is the red box plus the gold box. So $7 per unit is what the consumers are paying times 20 units. So you should have gotten $140 for total spending. Revenue for businesses, this is the total amount that the businesses take home, and that's just the red box here. So $4 per unit times 20 units, that's $80. Here's another practice question, or excuse me, sorry, here's the answers to the practice question. I thought I had another one on here, maybe I don't. Sorry, okay. That's it. Please come to class with questions. If you have any questions about this excise taxes and how it relates to elasticity, just remember that the less elastic you are, the more likely you are to get screwed. Thanks.